Daniel, yes. All these sessions are recorded, and let's see, who else? Who else asked me about? I'm good, thanks. Dylan asked me about the recording from the other day. Hey, Samuel, good. All of the recordings are posted. Let me show you. Let me go over that again. Ultra. So, oops. Double check. It should be up there now. You know, if you go up to this, tab for recordings, class meeting, class one. One of the things that changed is when it uploads the video, it will it defaults to like not publicly available. So I have to go in and make it publicly available. So sometimes, I don't know when you logged in. I think I did that yesterday. I made that publicly available. But usually if there's a problem, it just means I haven't gone in and made it public. So you can always send me an email and remind me to do that. But yes, there should be made public after that. All right. And I got to say, Miles, that is the most awesome picture ever. You look quite cool. So very good. Jasmine, let's see, Jasmine, down here, right? Jasmine is, last I checked, the only person to introduce herself in the discussion. So Jasmine, thank you, number one, for your service. Thank you for following instructions, and you get a gold medal for that. That is not the camera that we need to be using, right? We need to be using that camera. Okay. Hopefully better there. All right. So I've put a discussion folder out there just to introduce yourself. You know, it's kind of hard to, is it still, are you seeing me or are you seeing a baseball on the floor? What are you seeing? Both. All right. Well, we just have to look at a baseball for a little while. Because we are hopefully we'll actually work some problems today and get into some T accounts and some fun stuff. Completely lost my train of thought. Oh, it is hard to you know, be interactive in an online class. So introduce yourself. You know, get to know your classmates. Y'all probably know each other a little bit from other classes, unless you're taking all online. But you know, I encourage you to, you know, figure out ways to work together, either remotely or in person. So that's a good way to get to know each other. And kind of towards that end, you know, I typically don't, because I'm not on campus, I always assume that there's a ton of opportunities out there for you. You got like Meet the Firms Day, you got the career fair and all this stuff coming up later this month. A lot of people, I used to make these announcements and post all this stuff, and then everybody's like, we get those announcements like 3 or 4 or 5 times. So I typically don't. You know, make those, I don't post those anymore. I tend to forget about them, but please don't overlook those. And if you have questions about, you know, how to get involved, and I encourage you to get involved in as many different things as you can. So keep your eye out for those career fair and stuff like that. Okay. Let's see. I think that there are about 7, 8 of you who are not registered on Connect yet, so I won't publicly shame you today, but Tuesday we will have a public shaming. Okay, you know who you are. Yeah, do get registered on Connect. That's where we're going to be doing our homework, quizzes, and exams. So super important that you do that. Are there any questions after you've had a chance to go over the syllabus, Connect, class administration, or any of the material that we got into the other day? Any questions about that? Any questions about anything, like, I don't know, life, Falcons, search for a coach, the Braves going to make the playoffs again? I'm here for you. Is anybody awake? Is anybody with me? Here's the Falcons draft. We got the 4th pick, right? Devontae Smith. We should draft Devontae Smith so that we'll have all 3 Alabama wide receivers. Now, so Myers going to the Jaguars. I will be. Yeah, I'd like Todd Bowles. That is true. I don't. I would be very disappointed if Joe Brady is still considered his coach. I think that's kind of weird. It's the only one that doesn't make sense. I'm going to be using these videos for like years down the road, and people are going to be like, what is he talking about, 5 years from now? So anyway, all right. So a few people are awake. People are more interested in talking football than they are accounting. So I'm assuming no questions on the syllabus or anything like that, right? We good? All right. All right. Well, let's jump back in. So again, chapter 1, we're dealing with, let's see here. Chapter 1, we're dealing with investments in other companies. So we talked about the other day how we account for one company investing and buying the stock of another company depends solely on the level of influence. And there's three categories. Essentially, less than 20% is, we're going to use the fair value. You're said to have no influence. Between 20 and 50%, you're said to have significant influence. And we use the equity method, which is going to be really the focus of chapter 1. And then greater than 50%, we're going to produce consolidated financial statements, which is going to be the focus of chapters 2 through 6. Okay, so we talked a little bit about the other day, and we'll get more into it today. The focus of chapter 1 is not really on the fair value method, but I do want you, in understanding the equity method, I want you to understand the differences between the equity method and fair value. So we're gonna kind of talk about this. We're going to get into some of the journal entries for an investor. So when a company buys shares of another company, and specifically when they buy between 20 and 50%, then we're going to create an asset called investment. And I don't get really hung up on in account titles in this class. You'll see sometimes the account titles, it just needs to really talk about what it needs to be descriptive, right? So if we buy stock in another company, it can be called investment, it can be called marketable securities, it can be called investment in XYZ company, equity investment, it can be called any number of things, okay? But at the end of the day, for your own purposes, I just want you to understand what it is we're talking about. We're going to use the accrual method to record investment income, okay? And with the equity method, we are going to, the equity method, and it's called the equity method because it really works like retained earnings, which is an equity account. the investment is going to be increased by the percentage of the investee's net income, and it will be decreased by a percentage of the investee's dividends. Okay, so if the investee makes a profit, then the investment account is going to go up. If the investee records a loss, then our investment account will go down. The investment account is decreased by cash dividends. Now, let me say that again. The investment account is decreased by cash dividends. Okay, this is the major point of convergence between, or divergence between, the equity method and fair value. We talked the other day, using the fair value method, dividends are recorded as income. But under the equity method, they are not considered income. It is a reduction of the investment account. And the investor shall recognize its share of earnings or losses in the period in which it's earned. And so, like, if you want to know what that looks like, kind of a funny story that I vividly remember. I was working on the audit of Rheem Manufacturing in Montgomery, Alabama, and we finished. We were basically finished with the audit. One of the things that we had to do is we had to record the equity income from a related party that they own down in Mexico, and this was back in 1997. This was prior to the internet, the capabilities that we have right now. So literally, it was a Thursday, and we had to record the equity income. We had to make all the equity journal entries. So we had to call this company and find out what their income was. Did they declare dividends, et cetera, et cetera. And we called down there. It's about noon, and it just so happened it was May the 5th. And so literally we had been in Montgomery for like 3 weeks, and this is all we needed is one piece of information. And we called down there, and they're not in the office because it's Cinco de Mayo. So we, and because it was Cinco de Mayo on Thursday, they did not work on Friday. So we had to go back down to Montgomery, Alabama an entire week because we had to gather the information to make the equity method adjustments, because we waited till Cinco de Mayo to gather that information. So, but that's literally what we do. We will find out the information about earnings and dividends from the investee. So here's an example. Big company owns a 20% interest in little company. Now, I mentioned to you the other day, it's going to be pretty self-explanatory in your problems, but you know that 20% can kind of go either way. You could at 20%, you may or may not have significant influence. So the reason they choose 20% here is because they're going to show you, doing it using the fair value and the equity method. So 20 is right on that border. But in the problems that we're going to do, we're going to say, big company owns a 20% interest that it bought for $210,000. That gives them significant influence. Or you'll see some code words that'll give you an idea of how we're going to account for this. But the reason they don't in this problem, you'll see in the next couple of slides, is because what they're trying to do is compare and contrast. So Big owns a 20% interest in Little. It bought it in January 1st, 2020 for $210,000. Little reports net income of $200,000, $300,000, and $400 over the next 3 years. It declares dividends of $50, $100, and $200. What is the fair values? $245, $282, $325 at the end of, I think those dates are wrong actually. So it should be 20, 21, and 22, respectively. Okay. All right. So this is the worst slide ever because the slide used to be quite different. But in 2020, if we were using the fair value method, then we're talking about this, right? These basically these boxes right here. In 2020, the income of little company was 200,000, and it declared dividends of 50,000. If we're using the fair value method, what will we include as net income? We would include the dividends of 10,000, and we would include the increase in fair value. The fair value went from 210 to 245,000 right here. So what would be included in income would be these two items. And what would the balance in the investment be? It would be mark to market, so 245,000. 245. The next year would be 282, and the next year 325. So under the fair value, see there you go, 282, 325. This is going to be the fair market value adjustments right here. And this is going to be the dividends. So our percentage of dividends and the increase in fair value are going to be included as income. So it looks like if you add these two together over those years, it's going to be 185,000. Now, under the equity method, the equity in investee income, it would be 40,000. Does anybody know where that 40,000 comes from? Where do I get 40,000 from? 200,000, yeah, their income, 200,000, and we own 20% of that. So that's going to be 240,000. And then the final balance in the investment is 240. Remember, the investment began at 210, it went up by 40, and it went down by 10, which is our dividends. The 50,000 in equity income less 10,000 in dividends. And by the way, for any of you that are totally lost right now, just hang on. We're gonna look at T accounts, and this is gonna make a whole lot more sense. I'm just kind of running through this real quick right now. Here are the journal entries that we would make. And again, these were the journal entries that, I had to sit in a room in Montgomery, Alabama, waiting on getting. Investment in little company, 40,000, which is 20% of Little's net income. And this is going to be the income that we report. And again, remember I was talking about account names, equity investee income, investee income would be fine, or income from equity investment. You could see that written any number of ways. Technically, and so this is our dividend. I don't like that they do this in two parts, but technically, the dividend receivable and then decreases, and then the cash is paid, or the dividends paid. You could skip a step here, right? So this should be cash and the investment. The other thing that we need to do in the full equity method is to allocate the cost of an equity method, and we're going to compute amortization expense. And again, this is to adhere to accrual accounting principles. Okay, so we know that there are differences between a company's book value and fair value. So the book value, and while I'm here, what does book value mean? What is when you hear the term book value, what does that mean? Very good, historical cost, right? So let me broaden that out, Daniel. Book value is what items are presented on the financial statements, right? So the book value for land is historical cost. The book value, the book value for buildings and equipment is cost, historical cost minus accumulated depreciation. And so book value is what items are presented at on the financial statements. What else? What's another? And again, that a correct answer. But there's multiple definitions. What else would book value be? The book value of a company. Anyone? Anyone? What is the book value of a company? When you see differences exist between a company's book value and fair value. So we talked about, like, one definition of book value is what items are presented at according to our accounting rules on the financial statements. All right, let's see here. Let's see. I can't ever find a gold star, so I'm going to give you a pink brain. Okay, awesome. The difference between assets and liabilities, right? So the book value is, what is a company worth on its books? Well, if you take all the assets and you pay off all the creditors, you pay off all the liabilities, then you have what's left, right? That's its book value. And so assets minus liabilities also equals what? Broader than that, equity, right? Stockholders' equity, owner's equity, or just broadly equity, right? So book value, when you're talking about differences may exist between a company's book value, what it's worth on the financial statements, that would be its equity, common stock, retained earnings, additional paid-in capital, or assets minus liabilities, and those arise from what Daniel said at the beginning, which is differences between how things are reported on their financial statements. Okay. So fair value is based on multiple factors, including but not limited to profitability, new products, dividend payments, etc. There's an easier way to talk about this, right? So, like, let's say that I am a company, and the only asset that I have is land, and the land that I have, I bought, it's in the middle of New York City, and I bought it back in 1930. Okay, I was not alive in 1930, so please, don't accuse me of that. But if I bought land for $100,000 in the middle of New York City, what would that land be reported at on my balance sheet today? Purchase price, historical cost, right? $100,000. Where did $140,000 come from? Like, you just invented numbers, or maybe it's a typo. But if I bought it for $100,000, inflation like that, it would be historical cost, right? 100,000. Sorry, yeah. So I bought it for $100,000 back in the 1930s. How much would that be worth now? Like $1 billion, right? Or something crazy. So if I'm selling my company and all I have is this land that looks to be $100,000, I'm not going to sell it. Somebody comes up and they're like, well, let me look at your financial statements. Oh, the book value of your company is $100,000. I'll give you $100,000 for your company, right? Like, that would be insane, right? Like, we sell it based on fair value, and that's why you see things like we were talking about the other day, like Tesla stock, right? What assets do they have? I'm sure they've got some assets, but it doesn't relate to what their stock is selling for. Their stock price is based on, which would be their fair value, right? Would be based on their new products and their projected operating results. Okay. So assets and liabilities, we measure historical costs rather than current value. So, you know, we have differences in, you know, our fixed assets and things of this nature. So oftentimes the purchase price is going to exceed the book value of the investment acquired. And what our job is, one of our jobs, and I teach intro accounting right before this, or I guess it's now principles of accounting before this. I try to differentiate between, you know, most people think accounting is simply bookkeeping. And bookkeeping is a basic component of accounting, but the reason that we get paid and we can get paid really well is to do things like this, right? One of our jobs is anytime there's an equity investment or something of this nature, it's our job to identify the differences between purchase price and book values, okay? And there's really only two reasons that companies would pay more, right? And again, one of the things about accounting to understand, and I'll say this quite a bit throughout the semester, is, you know, we just basically report the news, right? We don't make value judgments. So, you know, if we say like, well, the book value of your company is 100,000, but you sold it for 500,000, that person must have overpaid. Well, overpaid is a value judgment, right? Like, why did they pay me 500,000 for something whose financial statements only showed 100,000? Well, there's two reasons why they would pay more. Number one is because the assets and liabilities have changed in value. Like in my case, you know, the example that I gave, ignoring inflation for Jason's purposes, the land is worth 100,000. The land has a book value of 100,000. Somebody came in and was willing to pay me 500,000. It wouldn't be right to say that you know, that they overpaid, because that land might be worth 200 million or something crazy, right? But the reason that they would pay me 500,000 is because the asset is different. The fair value of the asset is different from its book value. Okay. The other reason that people would pay more than the book value is for some intangible benefit. There's going to be some benefit that is going to accrue in the future, and as we know, that is the definition of goodwill. Okay, and in particularly chapter 1, when we're dealing with the equity method, this intangible, like Coca-Cola, the company Coca-Cola owns a ton of Coca-Cola bottling facilities, right, as equity investments. Why do they own these? Well, when they need bottles, right? And if they have an equity stake, if they own 30% of the stock of a bottling company, then, you know, when they say jump, that, you know, those companies are going to say how high, right? I need bottles. I want you to produce them. And so that's going to be some future benefit that is going to be expected. So here's an example. Grande is negotiating the acquisition of 30% of Chico. Chico's balance sheet reports assets of 500,000 and liabilities of 300,000 for a net book value of 200,000. And this is why I kind of harped on that earlier. This is a concept that you need to really understand. Assets minus liabilities gives me a net book value of 200,000. Grande determines that Chico's equipment is undervalued by 60,000, and one of its patents is undervalued, but only by 40,000. Okay, and again, that makes sense, right? Like the patent, you know, is kind of weird in the way that we accountants record patents. That, you know, what's the value of a patent from an accounting standpoint? It's only what we pay, you know, attorneys to, you know, file the patent. But what's the patent on, you know, some drug or you know, the Moderna's, you know, probably has a patent on their vaccine. You know, it's worth unlimited amounts, right? But on their balance sheet, it's only reported at whatever they paid the attorneys. So adding these valuation adjustments indicate that the company's net assets are valued at $300,000. So again, what we're saying is that $200,000 plus $60,000 plus $40,000. So Grande offers $90,000 for a 30% share in the investee's common stock. All right, everybody follow me so far? All right. Now, this is an important concept. This is going to be kind of the foundation of all the problems that we're going to do from now through chapter 5. And it's going to evolve a little bit, but this is going to be like a basic, I call this a value analysis, okay? So what we're going to do is we're going to look at Grande's purchase price, and we're going to figure out why the purchase price is different than the book value acquired. So they paid $90,000. That's a known. That's a given. How much book value did they acquire for that? Well, the book value is $200,000, and they acquired 30%. So they acquired $60,000. So it looks like they paid a premium of $30,000. Again, this is a premium. It's not a like, oh man, you overpaid or you got ripped off or whatever. No. Why was Grande willing to pay $30,000 more than the financial statements indicated? Well, part of it's because that equipment, and part of it's because of that patent. Okay, the patent, we bought 30% of that patent, which is $12,000. We bought 30% of that equipment, so that explains all of the payment in excess of book value. So if this had been $40,000, then the 18 and the 12 would explain $30,000. What would be the additional $10,000? Because one of our jobs is to explain that premium that we paid. So we've explained $30,000 right there. What if the payment was $40,000? What would the remainder go to? Goodwill. Very good. Wasim, you having trouble getting a good connection? I see you like coming and going. So
sorry, Professor. I was on mute. Yes, I'm having problem with the internet. I'm actually outside a Starbucks in my car attending the lecture. I'll watch the video later.
Yeah, I wasn't trying to embarrass you by calling you out, but certainly it will be posted. A lot of people have had internet problems in my first class and stuff too. So certainly go back and watch it, and if you have trouble. All right, so you can buy a double grande mocha while you're waiting. All right. So these, the excess purchase price related to tangible assets, we're going to amortize. Now here we go. This is why we take accounting, right? To learn etymology. Etymology is the study of words. What is amortization? This is like a real question, by the way. What is amortization? It's from a Latin word. How about this? Tell me, what is the root word? It is the assigning of costs. Okay, we're getting somewhere. It's depreciating intangible assets. So if you combine those together, like what Miles said and what James said, we're assigning the cost, very similar to depreciation, of the intangible assets. What's the root word? This is the important part, right? What is the root word of amortization? Amortize, which means what? To kill. Aaron, you were the first person in like I think like 8 years to ever know that. To kill. Most people say amor, like to love, right? No, what we're doing is we have this balance in amortization and we kill it, right? We allocate it. We allocate the cost of that over different years. All right, Aaron, let's see. Aaron, I'm gonna have to give you, let's see. I'll give you I love emojis. I'm gonna give you a bone, and as an awesome answer. So yes, we are killing that balance, and again, intangible assets are going to go down to 0. Okay, so we're gonna kill those balances. So we have an amortization table. Yes, to kill. So let me go back. So etymology. If you're ever on Jeopardy, you need to give me a shout out, right? Because the root word is morte, which means life, and a morte. A means against life. So a morte means to kill, like Mortal Kombat. So amortize means to kill. All right. So our journal entry is going to be to reduce the income and to reduce the investment. Okay, I'm going to put all this together here in just a minute. Okay. Oh, I wanted to point out a couple of things too. I didn't. This is the first time we get to this. I mentioned the other day that we don't cover variable interest entities in Chapter 1 because we cover it fully in Chapter 6. Here's my little soapbox on international accounting standards, okay? International accounting standards, back when I was in the PhD program in like 2008, everybody was like, oh man, we're gonna have convergence, like we're gonna shift over to international accounting standards. And I kind of took a wait and see approach. I don't think we will ever have a solid one set of accounting standards. I just think culturally the way that different countries do business is quite different, right? I think what we've done is we've taken steps so that international standards and US standards are very much closer than they used to be. So they're a whole lot more comparable, but there are some issues that are never going to be resolved. Particularly with consolidations, there's not a lot of differences between there's not a ton of differences between international standards and US standards, so you won't see any questions about international standards on the exam, and for the most part, I will skip over those in discussions in the class lectures. Okay? All right. So let me actually kind of take a let me deviate here. All right. So everybody that was asleep, wake up now, and like we're into some, we're actually going to do some stuff now. All right. I am a creature of habit. I like to make things as simple as they can possibly be, right? Are y'all familiar with T accounts? Does everybody love T accounts? Awesome, good. When in doubt, T it out. That's the motto for our class, okay? But I just wanted to show you, I do everything in the exact same order every single time. So like our investment account, all right? I'll take everything that we just learned just a minute ago, and we can really break it down into a T account quite nicely. Beginning balance. And again, you know, investment is an asset. I'll show you how I learned debits and credits. Pregnant Alice. Has anybody ever heard of Pregnant Alice? Christopher, you did Pregnant Alice? So like this is Alice, she's pregnant, right? And so this is her belly, she's standing sideways. This is her belly. Normal balances, assets, liabilities, income, capital, and expenses. So expenses, losses, assets, incomes, and gains is over here. So pregnant Alice is how I always refer to my normal balances. Beginning balance. Did I tell you my wife's pregnant? I'll next class I'll have her model for us, and it'll be like a Cindy. She would probably kill me for even just saying that right now. So what makes the investment account go up? Let's just make sure she never gets a hold of these recordings. All right. Debit. She's yelling at me from the living room. A debit. What specific debit? E is expenses. What's our specific journal entry that makes the investment go up? Percentage of net income. It's really two things that we're concerned about is tracking the investment and how that investment affects the income statement. Everybody with me there? So what makes the investment go up? Percentage of net income. What makes the investment go down? It could be a loss. Very good, Michael. It could be over here. It could be a loss would make it go down, but dividends. And where does dividends go over here? Would that be a debit or a credit? That's a trick question, Daniel. Let's see. I've got to give you the alien. Oh man, I'm giving you all the alien face. I'm gonna have to ramp it up. Then I'm actually gonna have to give you a tooth. I'll give you a tooth for credit. Anybody know the correct answer? Where does dividends go on this income over here? Not part of income. Okay. Now, the reason I belabor this point here, and I give people a tooth and an alien face, is so that you won't forget this when it comes time for the exam, right? Fair value, using the fair value method, dividends are included in income. Equity method, dividends only reduce the investment account. Okay, it's just like, and again, think of it, it's called the equity method. It acts just like any other equity account. Okay, like retained earnings. You know, when we pay retained earnings, what does it do? It reduces our reduces our retained earnings. So that's what the dividends does. Okay. Amortization decreases the investment. Why? Because it decreases our income. So again, these numbers will be the same. These numbers will be the same. Everybody with me so far? Well, I see him sucking down a coffee, like, yeah, whatever. Gross profit deferral. We're going to talk about this. I think it's learning objective 1-7, gross profit deferral. This is the heart of chapter 1 right here, okay? Like, I know it seems crazy. Like, I just got this, random, notebook sheet of paper, but all your questions about chapter 1 are going to be right here, okay? What is we're concerned about what is the ending balance in the investment account, and how does an equity investment affect our income statement? And what you're going to find is that, like I said, I am a creature of habit. So this T account right here is what I go through every single time I work an equity method problem. Okay, beginning balance, percentage of net income, percentage of dividends. Did they have amortization? Yes, I'm going to fill that in. Did they have any intra-entity inventory sales? If they did, I'm going to include this. If they didn't, I'm putting a 0. But my T account is going to look the exact same way every single time. All right? The big takeaways. Dividends are not included in income. This is how you determine the income from equity investment. Okay? Now, let me actually... I'm coming back. I'm coming back. I just wanted to prove to you a couple of things. I can't remember who asked it earlier. This is page 29 in the book. Let me go to a pencil. All right. Page 29 in the book. Somebody was asking earlier, like, what do we need to know about fair value? Under fair value accounting for an equity investment. Again, so we have a we have an equity investment. We're either accounting for an investment in another company using the fair value method, or we own less than 20%. Which of the following affects the income the investor recognizes from its ownership? The investee's reported income, changes in fair value, intra-entity profits, other comprehensive income. Anybody got an answer for me? We're using fair value accounting. Which of these would be included in income? Oh, sorry. All right, hold on. How's that? Under fair value, I feel like an eye doctor. Better A or B? Under fair value accounting, which of the following affects income? A, B, C, D. B. Daniel was, you got to be more authoritative. No question marks, right? Yeah. So fair value, if we're using the fair value accounting, what's going to be included in income? Dividends and changes in fair value of the stock. If we're using the equity method, what's included in income? Percentage of net income, amortization, and gross profit deferral. We'll get into gross profit deferral. It'll probably be Tuesday before we do that. But that would be gross profit deferral. The other thing with an equity method, we don't care about the fair value. We don't care about the fair value if we're using the equity method. Okay? All right. So let's carry on, and I'll continue to prove my point that all you need is a T account. I think that's true of life too, right? Like if you just had a T account, everything's good. January 1st, Belleville paid $2,295 to acquire 90,000 shares of O'Fallon's voting stock, which represents a 30% investment. Again, you know, for our purposes, we can really highlight 30% is going to be equity method. No allocations to goodwill or other specific accounts were made. Significant influence is achieved. So if you didn't know that 30% is going to be equity method, significant influence tells us it is. And the next sentence tells us it is. Belleville applies the equity method. O'Fallon declared a $1 per share dividend during the year and reported net income of $750,000. What is the balance in the investment in O'Fallon found in the financial records as of December 31st? All right. Let me so with our T account, investment account, beginning balance, 2295. Acquired 90,000 shares, which represents 30%, so we're going to use the equity method. What other journal entries do we need to enter into our T account? And again, we're trying to find the balance in the investment in O'Fallon. So even though we could, you know, have an income account, we don't really need it. What other entries need to go on our T account here? Debit the investment for 225, and 225 is what? The net income of 750 times 30%. All right, what else? Good, very good. Credit the investment for 90,000, which is babe, can you go with Mama? All right. So we're going to credit it for the percentage of dividends. Now, the dividends can be asked in a lot of different ways, okay? That's why I wanted to point this out. It says that O'Fallon declared a $1 per share dividend. So how much dividends did we receive? $1 for every share that we owned, which was 90,000, okay? So we don't have to make any adjustments. That is the actual dividend that we received is 90,000. So that full amount right there is going to be included, okay? Now, the other way that you're going to see this asked is it might say O'Fallon declared $100,000 of dividends. If they said that, then what we would know is that of that 100,000, we only received 30%. Okay, so again, you have to read these very carefully. Okay, what else? Amortization is 0. And gross profit is 0. So to solve the problem, we're simply going to add these and subtract this, and you will come up with an answer of so B. Lane, I love it. I love that you just cut straight to the chase and say like, hey, how similar is this to what's going to be on our test? Very. Now, obviously, this is the simplest case, right? But this would be a high probability, exam question, right? And it's simple because we didn't have any amortization and we didn't have any gross profit. But this is just what it is, right? And I'm not making fun of you. I mean, like, but it's important to think. Yes, Aaron, I'm gonna come right back to that. Okay, I'll explain how to take percentage of dividends and when you don't need to. I'll tell you why. Okay. What I want you to do is I want you to think about like not only this question, because yes, this is an exam type question, but what else could I ask you? I could ask you how much income would be shown. Well, the income from this would be 225. Oops, other side. Okay, and right now, like you're like, oh, of course, right? Like that seems like but when you get on the exam, I have people that try to make this so much harder. Like I'll give you this, and I'm like, how much income from equity investment would be reported on the income statement? And people take, some people try to take the dividends, and so it'd say like 315. Some people take only the dividends, they would say 90. Some people try to subtract the dividends, and they would say 230 or 135. But what I want you to do is not only like answer the question, but anticipate. Like view it as a football game, right? Like as you're going through, like, all right, I got this. Now, how would Abernathy try to what other plays would he run off of this formation, if you will, right? All right. Okay, Aaron, I'm gonna get to your question. It's embedded in this one, so we're gonna take a look at it. All right. All right. Stella's left, so we can talk bad about her. She told me she has to leave early to get to another class, and she said she's gonna watch the videos. So we're gonna see if she actually did. Okay. Yeah, absolutely, Jeffrey. That's why, your quizzes and things like that are actually come from the test bank. But yeah, absolutely. I can think of, this is a really simple one, but there's two really good questions I could ask you from this one. But this problem we're going to do now, so let's do number 7. I can think of probably a half a dozen questions I could ask you from this, right? So I want you to understand these problems, front and back, and it's not a regurgitation class. January 2020, Domingo acquired 20% of Martez for $700,000. This investment gave Domingo the ability to exercise significant influence. Ding, 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 right? So that was the whole purpose of the lecture the other day. You should be thinking significant influence, equity method. Balance sheet on that day showed total assets of 3.9, liabilities of 900. Any excess of cost over book value is attributed to a patent having a remaining useful life of 10 years. In 2020, Martez reported net income of 170. In 2021, 210. And then they paid dividends of 70,000 for each of those 2 years. What is the equity method balance of Domingo's investment in Martez at 12/31/21? Now, let me tell you that we're going to work this problem. When we get done with this problem, this will probably run us up to the end of class. If you can do this problem and you understand this problem, and you understand not only like how we arrived at the answer, because the answer on this problem is just, it is what it is, right? What I want you to understand is how and why we did what we did in each of the steps, okay? If you can do that, then I truly believe that you have probably mastered about 80% of chapter 1, okay? Promise you. Okay. Now, in this problem, we have another complicating factor is that we have a premium. We have a premium to worry about. Okay, so what we need to do is we need to do a value analysis. All you have is a big view of my finger right there. So I'm gonna lift this up just a little bit. And the purpose of the value analysis is to allocate our purchase price. Okay, so what is our purchase price? We paid $700,000. So for $700,000, how much book value did we acquire? Well, the book value of the company is 3.9 minus 900,000. So So 20%. Okay. Everybody with me so far? So we paid a premium of 100,000. Okay. Now, this kind of goes back to it's similar to the dividends question that Aaron asked. It tells me that any excess of cost over book value was attributed to a patent. So all 100,000 of this is attributable to the patent. And that has a useful life of 10 years. So our annual amortization is going to be 10,000 per year. Now, the reason I point that out is because, you know, in the problems in the slides that we were just going over, and the other way that you could see this is that if it said that a patent was undervalued by 100,000, then we only bought 20% of that undervaluation, or that overvaluation, if you will. So this would be 20,000, and the remainder would be the goodwill. But it didn't tell us the specific fair value of the patent. It just told us that, hey, everything else, any excess of cost over book value, was attributed to the patent. Okay? So that is our value analysis. So now all we need to do is, and again, keep in mind, for time's sake, when it gets to exams and things like that, you know, you can kind of read ahead. What is the equity method balance of Domingo's investment in Martez at 12/31/21? All right, so all they're concerned about is the investment account. All right, and just for time saving purposes, then I'm not going to worry about the equity income side of it. But, you know, if you're working the problems, you can probably understand that, like, that might be a question that I would ask you, right? So we'll go to our T accounts. The investment account. What is, oh shoot. Fold it up like a fan. All right, what's my beginning balance in the investment account? $700,000. What's going to make the investment go up? Percentage of net income. Excellent. I think we're getting the hang of it. So Martez reported net income of 170,000. So 20% of that percentage of net income is going to be 34,000. What's going to make the investment go down? Amortization from the patent. James, you're throwing me off there because even though you're correct, I told you I'm a creature of habit. I have to do everything in order or the entire world will fall apart. So you are correct, but let's hold that for just a minute. Percentage of dividends, okay? So I'm joking with you, James, but I do everything like literally in order to make sure I don't miss any steps. Dividends. How many the dividends of 70,000 were declared in each of those years? Now, Aaron, is that total dividends or is that the dividend that we received? Total. How much of that did we receive then? %20. Very good. So you see there, they gave us the total amount of dividends that were paid, whereas in the previous problem, they gave us like a per share amount. And now we go back to what James said. Also, what reduces the investment is amortization, which we've got right here is 10,000. $734, $720, $710. So this is at the end of 2020. At the end of 2020, the investment is 710. Now, I'm pointing this out because you know, kind of going back to what we were just talking about. What questions could I ask you from this problem right here? I could ask you what's the ending balance in the investment at 2020. I could ask you how much equity income we received in 2020. What would your answer be if I asked you the amount of equity income for 2020? Wasim. Oh man, you went the wrong way, Wasim. I thought maybe you hit it the other way. Okay. Let's go this way. Michael's finally on it. Income. The income is going to be the 34,000. The amortization decreases the amount of income. Okay, so the income that would be reported for 2020 is 24,000. Wasim, I thought you had typed like 24,000 and accidentally hit the 3. So I was hoping you would go with 24. Does everybody see that? So the amount of income for 2020 would be 24,000. All right, so your homework is to do the same thing for 2021. Okay, so I did 2020. Our question asks, what is the balance in the investment at 2021? So again, thinking forward, let's figure out what the ending balance in investment is. And you could be thinking about, oh, what else would Abernathy ask me? I could ask you the income for 2021. Okay. So I want you to finish up that problem on your own, and we'll pick up there on Tuesday. Okay. So as I mentioned at the beginning of class, everybody follow Jasmine's lead. Introduce yourself in the discussion. Can we get shown a question with gross profit deferral? Is it you trying to jump into your homework, Luke, so that you can get it done? Let me, I will, Luke, if you got questions, yeah, I'll do two things, right? I'll upload the video, or maybe I'll make a short problem with gross profit just to introduce that. Gross profit is the more difficult part of chapter 1. And so what I tell people is, and the reason I went through this problem right here, we're going to spend all of next class doing gross profit, okay? And the reason that I said when I was working this problem, that if you can do this problem and you feel good about it, you've got about 85% of chapter 1 down, okay? Now, the reason I'll say that is because this gross profit concept, I like that it's introduced in this chapter, because we're gonna pick it back up in chapter 5, but it is one of the kind of the difficult conceptual things to pick up. So a lot of people get really frustrated, and what I tell people is, like, don't get so hung up on that you throw all of this out, right? Because if you got this, you got the majority of chapter 1. I'm going to ask you 7 questions from chapter 1. If you get 6 of them right because you work and understand this, don't even worry about gross profit. It's going to click for you, okay? So that's a little bit of my soapbox there. But that's the reason I'm gonna wait till Tuesday. I'm going to go over the gross profit stuff in a lot more depth, okay? Any other questions, comments, or concerns? Christopher, go ahead.
So this might sound like a dumb question, but like it always confuses me with the income. It's on the credit side. So does that mean like they're losing 34,000 or like it's income of 34,000?
Income of 34,000. So income, if you go back up to Pregnant Alice, right? Income is increased through credits, right? Like revenue, right? What do you do with sales revenue? Sales revenue is a credit, right? Does that make sense?
Yeah, it makes sense.
So that's my normal balance. And then expenses would be debits to that. So that would reduce it. Oh, yeah, no, I appreciate that, Luke. I can tell you that if I don't cover it, then you're not going to be tested on it. I can promise you that, okay? And that's for anything that we cover. If we run out of time, and we don't get around to some topics, I will explicitly tell you, like, hey, you might want to read this or something like that, right? So no, I would never do that. And again, like I said, one of the benefits of making sure that you're in class or you're watching the material is not only what we go over, but what we don't go over. So there's going to be a lot of things that we choose not to go over. But I'm going to spend a whole class, and if you don't see it, if you're not going to get on an exam and see an account title or something that we've not covered in class. I can promise you. Okay. So. Oh, cool. That for me, like, the way to, I treat this as, very much like face-to-face, and the way to learn this advanced accounting is just go pencil to paper and do it. If we were face to face, we'd be doing all this on the whiteboard. So thanks. I've been working on my handwriting on the whiteboard. I'm not so good at handwriting. So good to know. All right, y'all. Have a great weekend, everybody. Shoot me emails if you've got questions. Introduce yourself. Enjoy your weekend. And we'll see you Tuesday, okay?